Now, when I talk about customer centricity, and of course customer equity being one component towards that, I'm always making a big deal about heterogeneity, about differences across customers. So how do you account for heterogeneity when you're calculating and reporting customer equity?
Well, first of all, what you need to keep in mind, I have business in minds that have 1,000 of different customers. And essentially, if you have 1,000 of different customers, and if you think about it that way, if you have a retention rate, I mean, the actual event can only be the customer is going to stay or is going to leave. So, I mean, if you have an 80% probability, you're either 20% underestimating or 80% overestimating the results. So for the individual customer, you're going to make a mistake. But if you add it up and it's about the expected value, those kind of little errors, they should cancel out. So now if you tell me, well, we have two different kind of customers, let's say business clients and private clients, what I would recommend, I mean, you just split them up. You have two different segments or more than two different segments, and you just do the same exercise for each segment differently, for each segment separately. You add it up, you get a customer equity for your whole company, you get a customer equity, let's say, for your business clients, you get a customer equity for your private clients. If you're operating in different countries, I mean, you could add it up, you could split it up according to the different countries. So, I mean, there's not a limit in terms of segmenting. Essentially, it's always the same idea. It just depends on, as you mentioned, if you have a lot of heterogeneity, you shouldn't put them in the same basket. That's right.
And what kinds of industries do you think are better suited for the use of customer equity in general than not?
Yeah, there are some industries indeed that have better information, in particular those industries that can measure the customer history. So for example, if you're an online company, like an online retailer, it's easy. You can track all the orders from your customer because they have to log in to order your product. So that's very easy. It's usually also very easy for telecommunication providers because you know you have either a contract with them or you have a lot of information about the calling behavior. So you can kind of figure out how active is your customer with you. So I mean, for all those companies that can track the customer history, that's relatively easy. It's getting a bit more complicated if you move to companies that usually don't have direct contact to the end customer. For example, take Coca-Cola. Coca-Cola knows that they are selling lots of soft drinks, but they don't know whether you continuously purchase them or whether I do. However, what those companies have, they have panel data. And from the panel data, you essentially get the information about how many soft drinks do they drink and what is the share of that particular category that you have, let's say, as Coca-Cola. So if you can figure out that, let's say, the overall amount of soft drink you're drinking is going down, that's very likely a trend that is not going to stop in the future. If, let's say, Coca-Cola's share is decreasing from, let's say, a 40% to a 35% to a 30%, that's also a kind of information. Obviously, you have a trend going on, and you could also put that information together to calculate something like customer lifetime value.